Welcome to Griffonomics.
I'm glad to be here for this one.
Yeah, today we have a really specific mission for you. We're taking you on a granular, highly investigative deep dive into a radical transformation happening right now in the telecommunications space.
Which is usually a pretty sleepy sector.
Usually, yeah.
Yeah.
But we are looking at Verizon, and let me tell you, the stack of sources we've pulled for you today is extensive.
It's massive.
Right. We've got their 2025 10K, the Q4 2025 earnings calls, transcripts from the Morgan Stanley TMT conference, and just a whole slew of incredibly detailed analyst notes.
And we're synthesizing all of that to figure out what's actually going on under the hood.
Exactly. Our goal is to extract the exact roadmap of how Verizon is morphing from this, slow-moving, bureaucratic legacy utility company into a lean, almost fintech-ified, outcome-oriented powerhouse.
It's a total pivot.
It is. This is no longer just a story about who sells the most cell phones. It's really a fundamental reinvention of corporate mechanics.
What's fascinating here is the sheer context of this pivot. Because for years, if you look back at the industry dynamics, Verizon was essentially a hunting ground.
A hunting ground for T-Mobile, mostly.
Yeah, exactly. They had the biggest network, sure, but they also had this culture of complacency. Rivals were just aggressively poaching their market share while Verizon rested on its historical laurels.
Just coasting.
Coasting on brand reputation. But the data in these recent sources shows a definitive end to that era. We're looking at a company violently shifting its focus toward becoming a fiscally disciplined, cash-generating machine.
And the stakes for you, whether you're, analyzing the broader market or actively managing a portfolio, they're substantial. This turnaround story is completely reshaping the math behind one of the most widely held equities out there.
Right, and every structural shift like this, it always starts at the top.
It does, which brings us to the leadership. Verizon recently installed what the analysts in our stack are literally calling a new power duo.
Is quite the pairing.
Yeah, you have CEO Dan Schulman, who came over from PayPal.
Bringing that fintech energy.
Exactly. And then chairman of the board, Mark Bertolini, who people probably know best for his tenure running Aetna.
The healthcare giant.
Right. And what stands out to me is how Schulman is bringing this tech-forward, subscription-based lens to a legacy telecom. He's totally obsessed with recurring subscription math.
Specifically, the LTV to CAC ratio.
Yes, customer lifetime value divided by customer acquisition cost. It's very Silicon Valley. Meanwhile, Bertolini brings what the sources literally describe as a ruthless BS filter when it comes to corporate overhead.
And that combination is forcing a sweeping culture shift. I mean, management openly admitted in these transcripts that their previous culture was just too risk-averse.
They were moving too slowly.
The exact phrasing they used was that they were too busy admiring problems instead of actually fixing them.
Admiring problems. That's such a great corporate burn.
It really is. But now, Schulman is pushing what he calls a cowboy work ethic.
Which he joked about picking up on his ranch in Montana, right?
Yeah, exactly. The new internal mantra across the company is every day matters. And the explicit mandate is that they're finally playing to win rather than playing not to lose.
They're tired of ceding ground. Okay, let's unpack this. Because to play to win, you have to stop scoring own goals.
Which they were definitely doing.
Oh, absolutely. One of the most glaring revelations from those Morgan Stanley conference transcripts was Verizon openly admitting to past pricing mistakes. For the last 3 years, they relied heavily on what Schulman calls empty price increases.
Which customers absolutely hate.
Think about your own cable bill, right? When it suddenly goes up by $4 for some mysterious broadcast fee, but your internet isn't any faster, you feel cheated. That is exactly what Verizon was doing.
And the executives actually put a hard number on those unforced errors. It wasn't just vague regret.
What was the number?
Management quantified the damage, admitting that those specific pricing actions drove away 2.25 million net subscriber additions.
2.25 million. That's a massive defection.
It translates to roughly $3 billion in lost annual revenue over a 3-year period.
Wow.
It's a classic corporate misstep. By irritating the base for these short-term revenue bumps to appease Wall Street's quarterly expectations, they completely destroyed long-term customer lifetime value.
But the new strategy draws a hard line under that practice.
Completely. Going forward, every single price adjustment has to be tethered to incremental value that you, the customer, can actually see and feel.
So faster speeds, more data allocation, new bundled perks. Stuff that actually justifies the hike.
Exactly. You get more, you pay more. It's an honest transaction.
Which brings us to the actual structure of the business itself, and the scale here is just immense. In their 2025 results, the consumer group generated a staggering $106.8 billion dollars in revenue.
That's with a B.
Right, while the business group brought in $29.1 billion dollars. Now, in the consumer engine, they're hyper-focused on driving mobility net additions and getting customers to adopt more of those perks we just mentioned.
Because that makes the monthly subscription so much stickier.
But the business group is where we see Bertolini's BS filter really taking hold.
Oh, without a doubt. If you dig into the business wireline subsegment, the numbers are genuinely alarming.
This is the legacy stuff, right?
Yeah, think ancient copper wire networks and outdated enterprise routing hardware. This specific area has been bleeding between $1 billion and $1.5 billion in margin annually.
$1 billion in lost margin every year.
Under the old bureaucratic regime, that might have just been tolerated as, an unavoidable cost of maintaining a national footprint, just the cost of doing business.
But not anymore.
No. The new leadership is applying strict fiscal discipline here. They've laid out an aggressive plan to either sunset or completely exit these non-core margin-dilutive legacy assets over the next few years. They are cutting the dead weight.
And it isn't just old copper wires they're looking at. I mean, they're basically turning over every couch cushion in the building looking for savings.
Nobody's safe.
Right. There's a fascinating detail from a Wall Street Journal report in our stack. Verizon actually weighed cutting its billion-dollar 10-year sponsorship with the NFL.
The NFL, the holy grail of American marketing.
Exactly. They currently spend over $250 million a year just to be the official 5G network of the league. Now, they ultimately found that the legal penalties made exiting the contract prohibitively expensive right now.
So they're stuck with it for the moment.
Yeah, but if you're willing to put a sacred cow like the NFL on the chopping block, it proves that absolutely no expense is safe from this new regime. They are desperate to find cash.
It signals a complete lack of sentimentality about the budget. Every single line item has to justify its existence, period.
And that mindset is the foundation for their broader operational transformation.
Right, which leads us to the headline number the analysts are obsessing over, the $5 billion war chest.
Let's get into that.
Management has committed to a sweeping $5 billion operational expense, or OPEX, reduction plan for 2026.
Okay, but wait, let me push back on how they're actually getting there. Because in the fourth quarter of 2025, Verizon executed a massive headcount reduction.
Yeah, they eliminated 13,000 positions.
Right. Cutting 13,000 jobs sounds less like a strategic Fintech-ified pivot and more like a legacy company hitting the panic button.
That's a very fair critique.
I mean, how is gutting your workforce actually going to improve operations or customer service?
It's a question the analysts absolutely grilled them on during the calls. And the defense management offered is that they aren't just hacking away at the frontline customer service reps.
Okay, who are they cutting them?
They're eliminating redundant middle management layers and severely cutting back on third-party contractors that were basically clogging up decision-making. By stripping out that internal complexity, they argue they can move much faster.
Leaner and meaner.
Exactly. But the crucial point for you to understand is that they aren't just holding this cash to make the balance sheet look pretty for a quarter.
They're reinvesting it.
Yes, taking that $5 billion and pumping it directly into customer retention and network superiority.
The approach to problem solving is definitely changing. There was an analogy Schulman used at the Morgan Stanley conference that really stuck out to me regarding this efficiency push.
The hammer and nail one.
Yeah. He said that for years, Verizon operated like a company where the only tool they had was a hammer and every problem was a nail.
A very expensive hammer.
Totally. So if a customer called to complain that their home cell coverage was spotty, Verizon's default reaction was to just give them a free $1,000 smartphone to keep them from churning.
Which is an incredibly blunt force way to solve a problem that might not even be the phone's fault. It might just be thick walls in their house.
Right. It's the definition of inefficiency. But under the new data-driven approach, they actually analyze the cost to serve. Instead of blindly handing out a $1,000 phone, they send that same complaining customer a femtocell.
And for those unfamiliar, a femtocell is essentially a mini cell tower for your house that plugs directly into your internet router.
Right, and it costs Verizon a fraction of the price of a flagship smartphone. The customer gets perfectly clear calls, the root problem is actually solved, and Verizon saves hundreds of dollars on a single interaction.
And when you multiply that behavioral change by millions of customers, you start to see how they legitimately hit that $5 billion OPEX reduction target without just firing people. It's smarter operations.
But the operational expenses are only one side of the coin here. We also have to talk about capital expenditures, or CapEx.
This is huge.
And the phrase you need to remember as we go through this next part is the CapEx cliff.
The CapEx cliff is perhaps the most powerful financial catalyst in this entire deep dive.
Explain the mechanics of that.
Over the last several years, Verizon has spent billions upon billions putting antennas on everything from cell towers to streetlights, building out its 5G C-band network. It was a staggering infrastructure undertaking.
Digging up streets, laying fiber, all of it.
But as of the end of 2025, that build-out is about 90% complete. They're currently covering roughly 300 million people across the country.
The heavy lifting is done.
Exactly. Because the heavy lifting is done, the checkbook is snapping shut. Verizon is slashing its capital expenditures by $4 billion, bringing the total CapEx envelope down to between $16 billion and $16.5 billion for 2026.
So what does this all mean? Think about it. When you drastically cut your day-to-day operating expenses and you simultaneously fall off a CapEx cliff because your network is basically finished, where does all that money go?
It flows straight to the bottom line.
Straight to the bottom line. Let's look at the financial realities and that Q4 2025 review. The operational momentum is already showing up in the data.
The numbers were really strong.
Yeah, in Q4, Verizon reported over 1 million total net adds.
Which is their highest in 6 years, by the way.
Huge. And that included 616,000 postpaid phone net adds. And just to clarify that term, postpaid phone net adds are the industry's gold standard metric.
Because these are the reliable, monthly billed customers that drive predictable, recurring revenue, not just prepaid burners.
Exactly.
Those operational wins, combined with the CapEx reductions we just talked about, create an unprecedented free cash flow inflection. For 2026, Verizon's guidance projects $21.5 billion or more in free cash flow.
$21.5 billion.
Let me pause and put that in perspective for you. Based on their market capitalization in early 2026, that implies a 10.4% free cash flow yield.
Which is wild.
It really is. When the risk-free rate, which is basically what you can get just parking your money in safe government bonds, is hovering around 3.6%, generating a 10.4% yield on a blue-chip company of this size is a staggering metric.
It offers a massive premium for investors who are willing to ride out the turnaround.
It really is a cash flow machine now.
And they absolutely need that cash because we have to talk about the balance sheet. Verizon is carrying a mountain of debt.
They bought all that spectrum, built the network. It wasn't cheap.
No. We are looking at net unsecured debt of $110.1 billion at the end of 2025, which puts them at a 2.2x leverage ratio.
It's heavy, but manageable.
Right, because they're generating over $21 billion in free cash flow, they have immense flexibility to handle it. In fact, right after closing their acquisition of Frontier Communications in January 2026, Verizon immediately took their cash reserves and paid down $5.7 billion of Frontier's high-cost debt.
Just wiped it out on day one.
Yep. And their target is to push their overall leverage ratio down to a very healthy 2.0 to 2.25x by 2027.
If we connect this to the bigger picture, the Frontier acquisition isn't just about absorbing debt or, buying up random regional fiber assets.
No, it's highly strategic.
It's the cornerstone of what management calls the convergence engine.
The convergence engine. The strategy here is genuinely fascinating. Picture a map of the U.S. Before the Frontier deal, Verizon could really only offer bundled wireless and fiber broadband to customers in 9 states.
Just 9.
Now, they have expanded that bundleable footprint to 31 states.
And here is the math of convergence. When a customer bundles their mobile phone plan with a home fiber broadband connection, their churn rate drops by 40%.
40%. That is incredibly sticky.
And the psychology behind it makes total sense. People just don't want the headache of unbundling all their services, dealing with multiple customer service reps, scheduling a tech to come change out their home routers, all just to save a few dollars a month.
It's too much friction.
Exactly. By reducing that churn by 40%, Verizon structurally expands the lifetime value of every single customer in that footprint.
It's the ultimate retention tool, and they're stepping on the gas with their fiber roadmap to make it happen. They've already doubled their synergy targets from the Frontier deal, aiming for $1 billion in savings by 2028.
And the build-out goals are aggressive,
Very. Right now, they have over 30 million fiber passings.
meaning homes or businesses that can physically connect to their network.
Right. But their medium-term goal is to hit 40 million to 50 million total passings. In 2026 alone, they're targeting over 2 million organic fiber passings. They are partnering with Tillman Global Holdings for out-of-footprint expansion, and they even bought a company called Starry to dominate the MDU space.
MDU.
Multi-dwelling units, like big high-rise apartment buildings.
Got it. It's a deliberate geographic land grab to establish a structural moat against competitors. T-Mobile, for instance, currently lacks a native nationwide fiber network, and AT&T has a significantly smaller fiber footprint.
But laying fiber isn't the only foundational layer Verizon is building here. We also need to look closely at their AI roadmap.
Because it is remarkably different from the rest of the tech sector.
It really is. Here's where it gets really interesting.
Right.
This is completely counterintuitive to what you see in the daily headlines. While rival tech companies and telcos are out there chasing the consumer AI hype, throwing billions at flashy conversational chatbots.
Verizon's AI strategy is strictly internal and operational. Exactly. Verizon has purposefully taken zero equity exposure to high-flying AI startups like Anthropic.
Which is such a contrarian move right now.
It is, but instead they're utilizing a model-agnostic approach. This is incredibly shrewd risk management. If one AI provider's models suddenly degrade or a startup dramatically fails, Verizon can seamlessly switch their back-end operations between Google Gemini and OpenAI.
Without taking a massive write-down on their balance sheet.
Precisely. They're using AI not to entertain consumers, but to quietly predict and prevent fiber cuts before they happen, to automate complex call center routing, and to directly support that $5 billion cost transformation goal we talked about earlier.
But just because Verizon isn't buying equity in AI startups doesn't mean they aren't positioning themselves to cash in on the AI boom. Enter Vibrant Capital.
Yes.
This initiative was launched in February 2026 and is led by Shadman Zafar, who is a former top-tier executive at Verizon.
Now, Vibrant isn't a direct subsidiary, but it is deeply entrenched in the Verizon orbit.
And their focus is entirely different from the consumer chatbots. Right. Vibrant Capital focuses exclusively on B2B, real economy AI. We are talking about logistics, transportation, and heavy industry workflows.
And we can tie this directly to Verizon's physical infrastructure. In late 2025, Verizon signed a strategic AI Connect deal with AWS.
Amazon Web Services.
Right? They are leveraging their vast network of dark fiber pathways, which is essentially the physical, unused fiber optic cables already sitting under the ground to serve the clustering needs of hyperscaler data centers.
These are the giant server farms run by companies like Amazon or Google that actually power the internet and run these massive AI models.
Exactly. Vibrant Capital acts as a company builder, creating the AI native applications that run directly on Verizon's 5G and fiber backbone. They are positioning themselves to be the indispensable plumbing of the AI revolution.
Which is a significantly higher margin business than fighting over retail wireless customers.
Without a doubt.
It is all coming together. So let's bring it home with the final verdict from our sources. Across our stack of analyst notes, the consensus rating on Verizon right now is a strong BY, viewing this as a classic turnaround play.
The sentiment has completely shifted.
Yeah, they're officially transitioning from a company that was losing market share and making unforced errors to a fiscally responsible entity focused on sustainable, profitable volume.
And they certainly aren't being shy about returning that cash to shareholders. Armed with that unprecedented free cash flow we discussed, the board has authorized a $25 billion share repurchase program.
That's massive.
And they're committing to buy back at least $3 billion in stock in 2026 alone. Furthermore, they pulled forward their dividend declaration, marking their 20th consecutive year of dividend increases. Management has gone on the record calling their commitment to the dividend ironclad.
But to keep things grounded, we have to look at the vulnerabilities. Everything we've discussed so far is the bull case.
This raises an important question. What could actually derail this momentum?
Right. What's the bear case here?
The primary risk factor glaring from the Q4 transcripts is brand trust. In early 2026, Verizon suffered a widespread network outage.
People were furious.
They were, and Schulman openly admitted on the earnings call that they failed to meet their own standard of excellence. For a company that built its entire identity and pricing power on network superiority, restoring their reliability premium is absolutely paramount.
Because if the network goes down, none of the rest matters.
Exactly. If they cannot maintain flawless network performance, all the convergence math, the fiber adoption, and the lifetime value calculations begin to break down.
It is the ultimate test of execution. They have the roadmap, they have the cash flow, now they just have to deliver on the engineering. Which leaves you with something fascinating to think about as we wrap up today's deep dive.
Indeed. We spent a lot of time today talking about subscriber metrics, convergence, and operational efficiency. But consider the end game of this strategy.
Where's this all heading?
If Verizon successfully executes this roadmap, if they manage to lock tens of millions of Americans into a single inescapable ecosystem for their mobile phones, their home internet, and the smart infrastructure that runs their cities, at what point do we stop regulating them as a competitive telecommunications company and start viewing them as a sovereign, inescapable utility that dictates the terms of the modern economy?
Risk defined. Portfolio protected.